Cargo cranes rise over Lagos, a high-speed train cuts across the savannah in Kenya. Deep underground in the Congo, cobalt leaves the earth, destined for refineries across the world. From ports and railways to cloud data centers and undersea cables, China is quietly building the plumbing of the 21st century economy. Some call it partnership, others, dependence. Today we unpack how China builds power across Africa and the Caribbean, the strategy, the money, the tech, the myths, and what it means for the next 25 years. Start with scale. China has been Africa's largest trading partner for more than a decade. Customs data show China-Africa trade hit roughly $296 billion in 2024, a record that nudged higher again into 2025. That's not just containers moving, it's leverage, relationships, and rules, shaping who buys, sells, and builds. In mid-2025, Beijing went further, announcing plans to remove all tariffs on exports from 53 African countries with which it has diplomatic ties. If implemented fully, that's a structural shift. Africa's manufacturers and farmers could ship to a market of 1.4 billion people at zero duty. It's also a soft power play, opportunity wrapped in access. The Belt and Road Initiative, BRI, is the master brand, but the toolkit is broader. Policy banks, Exim Bank of China, China Development Bank, commercial lenders, state-owned contractors like Czech and CCCC, and private champions in tech and logistics. The idea: lend plus, build plus, operate, sometimes on boot concessions, sometimes via EPC contracts, always bundling finance plus engineering plus equipment. Independent trackers, SAI's Kari at Johns Hopkins, have cataloged hundreds of Chinese loan commitments since 2000, peaking in the 2010s, then slowing but still extensive. The database matters because it gives us visibility into who owes what, to whom, and for which project. Critics warn of opaque terms and hidden debt. A 2021 aid data study argued many obligations were off government balance sheets via state-owned enterprises, estimating $385 billion in underreported liabilities globally across lower and middle-income countries. That research fueled concerns about transparency and fiscal risks. Case 1, Nigeria, Lekki Deep-Sea Port, Lagos. Opened in 2023, designed as Nigeria's first modern deep-water container hub, capable of handling 18,000 TEU vessels, with a planned 1.2 MTU annual capacity. Built by Chinese firms under a long concession, it's meant to unclog Lagos and rewire West African shipping lanes. Promise? Big. Execution risk? Also big. Connectivity and automation will decide how transformative it becomes. Case 2, Kenya, Standard Gauge Railway, SGR. A flagship of the 2010s, the Mombasa-Nairobi SGR, was financed primarily by China Exim. Operational since 2017, it boosted passenger and cargo capacity, but struggled to meet revenue projections. Fares were hiked in 2024 as Kenya wrestled with debt service and fuel costs, and auditors flagged avoidable loan charges and arrears in 2025. The lesson: infrastructure economics live or die on volumes, extensions, and last-mile logistics. Case 3, Zambia, from crunch to restructuring. After years of negotiations, Lusaka secured a deal with bondholders in 2024 and continued working through treatment for regional development banks in 2025. China, a major official creditor, was central in those talks. The takeaway: when Chinese and private creditors coordinate, exits are possible. When they don't, countries drift. Infrastructure isn't just concrete, it's code. Chinese vendors, Huawei, ZTE, equip large swaths of Africa's mobile networks. Safaricom's early 5G trials used Huawei gear, and Huawei Cloud has expanded availability zones in Egypt and Nigeria, after first planting its hyperscale flag in South Africa back in 2019. The bet: own the stack, radio to cloud, to shape standards and stickiness. Under the sea, data moves on fiber. Analysts note dozens of cables landing around Africa, with hubs in Egypt, South Africa, Djibouti, Nigeria, and Kenya, and Chinese players invested in some systems under the digital Silk Road. Control points along these routes translate to resilience or vulnerability, depending on your vantage. Hard power follows trade routes. In 2017, the People's Liberation Army opened its first overseas military base in Djibouti, near the Bab el-Mandeb choke point. Analysts say it can birth large warships and support carrier groups, a logistics node for blue water operations in the Indian Ocean and beyond. For Beijing, it's framed as anti-piracy and peacekeeping support. For rivals, it's foothold one. Security ties aren't just bases, they're port access, dual-use infrastructure, peacekeeping deployments, and defense training. The seam between commercial and military is intentionally thin. Where China builds deep-water berths or crane capacity, planners see options. The energy transition runs on minerals. In the DRC, most of the world's cobalt is mined. China dominates refining, a choke point for EV batteries and electronics. Recent analyses show refining concentration increased 2020-2024, with China the top refiner for cobalt, graphite, and rare earths. Beijing even stockpiles cobalt to steady domestic supply and pricing. This is strategic depth. Estimates vary, but US and academic sources consistently show Chinese firms control large shares of DRC cobalt production and projects, while China refines the majority of global cobalt, linking African mines to Chinese processors to global battery makers. Not everything is steel and stone. Confucius Institutes, Chinese-funded language and culture centers have grown across Africa even as some Western campuses shut theirs. Sources tally 60-plus institutes on African university campuses by late 2024. Add scholarships, media partnerships, think tank forums, and you get norms, networks, and narratives. On the rules front, zero tariff access and standard setting, from telecom protocols to customs digitization, pull partners into ecosystems where Chinese firms excel. That's durable influence. Is this debt trap diplomacy? The evidence is mixed. Research from Johns Hopkins and others argues the debt trap meme oversimplifies reality, that most crises stem from domestic fiscal stress, commodity shocks, and private creditor exposure. Recent studies show low-income countries pay far more to private lenders than to China, though Beijing's opaque terms and collateral clauses do complicate workouts. The truth, risk is real, but agency is too. The World Bank's 2024 International Debt Report underscores the pressure. Developing countries paid a record $1.4 trillion to foreign creditors in 2023. When money is tight, every clause matters. Why the Caribbean matters? It's US near abroad, near major shipping lanes, and home to small states that need infrastructure. Jamaica's North-South Highway deal gave a Chinese contractor land concessions. BRI MAUs spread across the region, while Guyana weighs Chinese bids amid an oil boom. For Washington, that's strategic proximity. For Caribbean capitals, whoever builds, wins time. China's superpower play is patient. It mixes market access, infrastructure finance, digital standards, and security logistics. For African and Caribbean leaders, the question isn't China or the West, it's terms, transparency, and transfer. Who shares risk? Who builds skills? Who keeps the keys? If you're an entrepreneur, policymaker, or citizen, this is the game board. The next decade will reward those who negotiate hard, diversify partners, and insist on value for money. Superpowers play chess. Make sure you're playing too.